Good morning again to everyone who's joined. Welcome to our webinar on mergers, acquisitions, and plans. My name is Amy Olette, and I'm a consultant with Multnomah Group. I've been working with retirement plans for over 10 years and have seen the good, the bad, and the ugly when it comes to retirement plans in merger and acquisition business transactions. We're here today to talk about what to be aware of if your company is going through a sale of some sort, since retirement plans for both the seller and the buyer are impacted, and the ugly happens when the goals for each are not considered before the transaction. I'm going to be co-presenting today with Bertha Minahan of Moss Adams, and I'll have Bertha briefly introduce herself.
Thanks, Amy. Hi, everyone. This is Bertha Minahan. I'm an audit partner with Moss Adams, and I have the privilege of being our national practice leader, and I lead the employee benefit plan group. And I, like Amy, have a lot of years of experience, a few more, and kind of, directing all phases of the audit and working with all types of audits. So we've seen quite a bit in the M&A world and a lot of other things that affect the plans and plan sponsors today. I sit on the AICPA's Employee Benefit Plan Experts Panel, and so that helps me see a lot of things, and we work closely with the DOL and the IRS in carrying out our audits on a daily basis. So it's great to be here with you all today.
So a few housekeeping items before we get started. This webinar will be recorded and available online a few days following the presentation. We will also email a copy of the presentation slides following the webinar. If you have any questions, please feel free to enter them in the questions box of your GoToMeeting panel. We'll address what we can today and follow up with you directly if we don't have a chance to address your questions during the webinar. If you'd like to receive continuing education credit for attending this webinar, please be sure to answer at least 3 of the 4 polling questions during the webinar and attend at least 50 minutes. We'll also follow up with an email with a link to a survey following the webinar that you need to answer to receive that credit. And if you have any further questions about receiving the credit, please contact Courtney Irvin of Moss Adams, and she'd be happy to help. Her email is right here on the screen, courtney.irvin@mossadams.com. So with that, we're going to launch our first poll question, and our question is who we have in the audience today.
It's always good to get a pulse of who's on the call and what roles you all have in sponsoring your plan.
We'll give it a few more seconds. All right, so it looks like we do have mostly people in finance and administration. Let me just jump to our agenda for today. We're going to be providing a brief overview of the types of business transactions that impact the retirement plan, namely the difference between a stock and asset sale. Each have different implications when it comes to sponsorship of the plan and options before and after the transaction. We're going to cover some key decisions that need to be considered for the seller if they sponsor a retirement plan, and what the buyer needs to keep in mind if that seller has a plan. There's also potential impacts for the buyer's plan if they sponsor one as well, related to how they have to treat employees that come over and what a merger of the plan looks like if they decide to go that way. And finally, there's some special considerations for nonprofit organizations that sponsor 403B or 401k plans. And as we have time, we'll also address attendee questions. And with that, we're actually going to launch quickly our second poll question, whether or not you've worked through a plan merger or termination before in any plans that you work with. All right, and it looks like we have an almost even split. Sorry, for those who have not been through plan mergers or terminations before. So hopefully this will be informational for both of you have before and what you've seen, and if you haven't, and hopefully don't have one on the horizon anytime soon. So we're going to start with an asset sale. An asset sale is typically when the buyer is looking to purchase something of value, whether it's a proprietary model, physical equipment, or land, highly sought after client information, etc. It doesn't actually mean taking over the buyer's company. And so as an example, I've sort of drawn out John and Mary own JMS company, a processing plant. Pat Buyer comes along and wants to buy a plant and all of the equipment inside, but doesn't want to take over the books of JMS company or actually become owner of JMS company. Pat may even be interested in keeping the plant itself running and could even hire all of the employees that worked at JMS company. The agreement itself, though, is to purchase the assets and maybe even some of the liabilities. But post-sale, JMS company still exists as its own entity. John and Mary may decide to shut down JMS company as part of the transaction or continue to run whatever part of the business they choose. If they still have other lines of business that they continue, they certainly have the option to do so. The ownership of JMS company, again, is still fully in the hands of John and Mary after an asset sale. Employees, if there's still work to be done for JMS, can continue on at JMS, or again, Pat may hire them to fulfill their same roles in our example at the processing plant. But from Pat's side, these are new employees. Even though they're coming in doing their same job, they are new employees to Pat in Pat's entity. And we'll get into details of how they have to be treated if Pat actually sponsors a plan a bit later. If JMS company sponsors a retirement plan, then everyone leaves to work for Pat, even if it's at the same plant. They're considered terminated for the JMS plan. Again, that's assuming that it stays under control of John and Mary and JMS company. So whether or not John and Mary terminate their plan, these terminated employees are eligible for distribution based on plan terms. If you do have a mass exodus for JMS or even a significant portion leaves, this often results in a partial plan termination for the JMS plan, meaning that participants are fully vested even if John and Mary don't fully terminate the plan. Again, in an asset sale, JMS company still exists as a separate entity as long as John and Mary want to keep the doors open and they still sponsor JMS company's retirement plan. And I mention this again just because I've seen situations in which the sellers, John and Mary, in our example, complete the asset sales, shut down the doors of their company, and they don't realize that since they were owners of the JMS company, they still have an obligation to continue to run or to terminate their plan. And unless the sale paperwork and documents specifically state that Pat Buyer is going to assume sponsorship of the plan, and many buyers don't actually want to do this in an asset sale if they can avoid it. John and Mary are not done with the plan. And this does look a bit different under a stock sale. In a stock sale, John and Mary get to waltz away from everything and that's owned and run by JMS company because they've essentially sold everything under the umbrella to Pat. Pat Buyer, in our example, is taking full ownership of the company and all assets and liabilities related to it. Assuming that Pat Buyer wants to keep JMS company running as it was before, keep that plant open and running, open for business, the employees can stay on to run the processing plant just as they were before. And if JMS company sponsors a retirement plan, they are still the plan sponsor. It's just that JMS company, as it's named, has a new captain at the helm, that being Pat Buyer. And I've actually heard the difference between the two described as similar to selling furniture versus selling a house. An asset sale is like saying you want to sell all of your furniture, but it's up to you what you want to do with your house after it's sold, whether you keep the house, sell the house, but all you were doing is selling the furniture as is to the buyer. And a stock sale, on the other hand, is like selling the house with the furniture still inside. Once sold, the buyer has full control over the house and all of the content and takes on the house's history with the purchase. So what does this mean if the sellers, John and Mary in our case, do sponsor a plan? Does it matter when they decide what to do with the plan? And of course, it does matter what type of sale they go through. So we're going to start with the easy answers. What happens to the retirement plan sponsored by JMS company if they sell the assets to Pat Buyer? As we said before, the retirement plan still exists under JMS company, and the company didn't change hands. If the goal is to wrap up the business and shut the doors, John and Mary will need to terminate their plan. But as the timing of the plan termination doesn't really matter since JMS company stays as is. It's not purchased by or related to Pat Buyer. Again, we're assuming that these are unrelated entities. If John and Mary keep JMS company running in some capacity, they can also keep the retirement plan up and running. I've seen this happen with doctor's offices. Maybe they sell their sell their practice in its current form, but they as an entity continue to see other patients on the side and have their own retirement plan that they continue. If they do lose a significant portion of employees during the transaction, though, again, they may experience that partial plan termination. And this is important to note because the employees that terminated, again, have a right to the benefits and they may become 100% vested. And in most asset sales I've worked with, the buyer does not want to assume the sponsor position of the retirement plan, since it also means assuming the history of the plan and potential liabilities that come with it. It's important for both parties to understand whether or not this is part of their agreement. Again, because I've seen sellers that think their plan was being taken over when it wasn't, or buyers that think that they have some sort of control over the plan when it actually had no part of the asset sale. If the buyer does want to take over the plan document itself has to be amended, and or they could do a spin-off and a transfer of assets to the buyer's plan, which must be completed by written agreement. Again, it's not just one of those things that happens automatically. Again, that's under an asset sale. On the stock sale side, it's important for both parties to understand that once the transaction is completed, the retirement plan still follows the sponsor company, JMS company in our example. Pat Buyer, when taking over JMS, also takes full responsibility of the plan, which has several implications. If the goal is to terminate the JMS plan, this can be done before or after the transaction only if the buyer, Pat in this case, doesn't sponsor a similar plan, one that would be considered a successor plan. If they do, the best approach is actually to have the seller effectively terminate the plan, the JMS plan in this case, prior to the transaction. So John and Mary in this case would need to start the plan termination process and actually execute paperwork with a termination date effective prior to signing the actual papers to sell the business to Pat. If that doesn't occur and Pat's company sponsors a 401k plan as well, Pat suddenly has fewer options when it comes to the JMS plan. With a successor plan considered in place on Pat's side, now the JMS company and Pat Buyer company are considered related, and Pat essentially can't terminate the JMS company 401k plan. So what does this actually mean for the JMS plan if it didn't come up and the papers are signed and suddenly Pat needs to do something with that retirement plan, and Pat also has a 401k plan of their own? So in this case, Pat can actually freeze the JMS plan and consider allowing JMS employees to participate in the Pat Buyer plan. And we're going to get into things to be aware of on that side of the equation in a little bit. On the JMS plan side, though, the frozen plan would no longer take contributions, and as participants left or retired, they can take benefits, but the plan can't actually be shut down entirely until all assets are naturally distributed. This means they have to continue filing Form 5500s, and if it's frozen, they don't have ongoing non-discrimination testing, but it does require ongoing administration. On the other hand, Pat could decide to merge the plan into the Pat Buyer company plan. And of course, the downside to this is that if there are protected benefits in the JMS plan, those benefits have to be maintained with the money brought over from that plan, along with sort of the whole history of the plan and any liabilities that come with that. As a third option, Pat could maintain the JMS plan as it is. Non-discrimination testing and annual reporting would continue as it did before. But with the two plans themselves are now run by related entities, so the non-discrimination testing has to take into consideration the coverage and benefits of both plans. We're not going to get into that level of detail here, but it's important to note that since it impacts the decisions made by the buyer for both how they want to treat the seller's plan and the buyer's plan. There is, of course, a brief transition period that's usually available where each plan can actually be tested separately as they were before the transaction went through, as long as certain conditions apply. And the transition period is generally for the plan year of the business transaction and the plan year following. So it gives a little bit of time to assess the coverage of each plan and the benefits, rights, and features available under each to see if it makes sense to merge them or close down one of the plans and bring employees into the other, or if they can be excluded from, let's say, Pat Buyer's plan altogether. The problem that we've seen, though, is that transition period is little consolation to Pat Buyer in our example if there was no kind of conversation that had to do with what to do with the JMS plan prior to the start of the stock sale. I've certainly run into the PAPs in the world that didn't realize that there had to be some sort of decision prior to the transaction, or that they would lose certain flexibilities that they expected to have once the transaction was made, and that they should have actually had John and Mary, in this case, terminate their plan before the sale was finalized, or at least get some ducks in the row to know what they were going to be doing. So with that, we're going to have Bertha get into some of the accounting and reporting considerations. And right before we do that, we are going to have our third poll question pop up here. And this is, does your plan have a governance structure or plan committee, oversight committee in place? And if you are working with multiple plans, the question is more, do you have a majority of your plans that have these in place, or a more majority that do not? Okay, it looks like most, we have a significant portion here that do have their plan, or majority of their plans have that governance structure in place.
That's great. Okay, thanks, Amy, and you advanced my slides. So Amy gave us a good background on what's happening at the sponsor level, and I think for the majority of the finance folks, since a lot of our attendees are finance folks, they'll appreciate that in any corporate transaction, there is a lot of impact on other things, and in this case, today we're mainly dealing with and focusing on the plan impact. So I was going to talk a little about the reporting and accounting for mergers and terminations, and sometimes I'll throw in something from a seller and a buyer standpoint. However, pretty much you're going to have the same challenges whether you're on either side, and with a little bit or some stark differences. But we just took the poll on the governance, so it's nice to have plan governance, because a lot of finance folks kind of look at the audit and just the reporting side, and of course there's a lot of administration and ERISA qualification things that you have to be aware of when you're going through a transaction. So kind of one of the things that Amy covered that resonates with me, because I am on a lot of M&A committees and watching the groups work together, and often one doesn't appreciate, if you will, if that's the right word, of what the other group needs to know and have to make happen for everything to line up properly, and of course for the deal to go through effectively, and for the employees to not have gone through any hardship and stoppage of benefits, or having access to their retirement plan and their retirement choices. So a lot has to come together. So it's good to see that we're sort of preaching to the choir, and the folks on the phone have governance committees, because they come into play heavily. So here I have kind of broken it out, merger and termination. I know Amy spoke about freezing plans, and maybe we'll talk a little when we get to the defined benefit plan we have below on where freezing might be effective, and the different types of freezing. But basically, there are some decisions to be made, and when you're going through a plan merger, oftentimes what gets kind of muddy, if you will, is who has sponsorship of the plan. So often we're working with clients where they've been acquired, say, and they're going, well, we have no idea what's going to happen with the plan, and we've been acquired, so should we care? And it's kind of a good question, but however, sponsorship hasn't formally passed to anyone, and the seller is still the sponsor of their own plan, and no decisions have been made. And again, as we just heard, if certain decisions aren't made at the time the deal is going through, there's fewer options when when the right group finds out that, wow, we've been acquired. So sponsorship is important to understand, whether you're going through on either side, to go, okay, we have some benefit plans, they're intact, and here's the sponsors, and tomorrow when we sign on the dotted line, have we formally moved sponsorship, or what has occurred? And so that's kind of key, because not only from a legal standpoint, but from a reporting standpoint of, okay, who can legally engage providers, who can legally, kind of go ahead and make those final filings and decisions for the plan. Now, mergers are often asset-to-asset transfer, which, again, we kind of forget this. So when we're working on mergers, it's important to understand that, the plan can have, can freeze its activity, let's say, right? I can have a plan. I've just been acquired. I freeze all participation in my plan. The plan is still hanging out, and I'm going to transfer the assets because I'm merging the plan with the buyer's plan. Well, if I'm doing that, the assets are going to transfer. Hopefully, they'll go trustee to trustee. So I'm going to have some reporting side on both plans, the plan that the assets are exiting from and the plan that's receiving the assets. And often if there's, they're reporting at year end, a lot of times this stuff happens close to a year end. Deals happen throughout the year, but sometimes it's literally, in December, and it's December 31 and both plans are reporting and they don't know who has legal right to the assets because they're either in transit or one plan has released and the other plan hasn't received, or one plan is liquidated, frankly, and a huge chunk of cash is being transferred to be, invested once the new plan receives it. So asset-to-asset transfers are kind of tricky. You got to understand when they're happening, and you have to be able to coordinate, going from buyer, seller, and what plan is reporting what. And again, sometimes it's not just, the legal distinction of, well, I've taken over your plan, so I have legal rights to all those assets, because the trust remains intact. So when you're reporting on the plan and the trust, it's important to know who still has custody of those assets and where they're being reported. And if a transfer is happening, trustee to trustee, when it's occurring, and of course it happens timely, so that there's not a huge lag in what is actually being invested in participant accounts. And again, that's going to be different, of course, for different types of plans, right? And we'll talk a little more about 403Bs a little later because they've just become like their own little animal, if you will, and they've kind of really morphed into having quite a few challenges since they've been requiring to have ERISA reporting since 2009, and they've come a long way. But they have a few other quirks. But here, for example, the defined benefit plan, maybe just the title of the assets is changed as, a plan goes through or a sponsor goes through being acquired by another company, and they assume the benefit plan assets, if you will, because they're technically non-participant directed, and they just take custody, and the reporting sometimes it becomes actually a little easier. There's cutoff issues to consider. Again, when you're going and you're merging plans, disbursements and receipts, it's good to identify, of course, the timing of that merger, and again, if you're setting up new custodians or a custodian is taking over something new, to say, okay, when is my last loan going to be processed out of? Where is my last contribution from payroll going to go to in a defined contribution plan? And that often, again, is hard for us. We come after the fact, even sometimes when we're working through a live merger, it's, okay, who's ready to take this contribution? It's the last payroll paid on this, this person's EIN, this company's identification number, and it's going to which plan. So that cutoff is pretty important, and again, it has to do with allocation and reporting-wise to make sure that both plans, again, are synced and who's picking what up. And the same for distributions. Oftentimes there's obviously monies left. There's forfeitures to be used, for example. It gets even hairier when it's what forfeitures are being allocated to whom. Are the forfeitures going to go over in one lump sum, or are they going to be allocated to the participants going over before they are, or who are they going to be available for going forward? Does the new plan have any forfeiture restrictions? So cutoff is really important for us, and again, that from a reporting standpoint becomes pretty sticky. Another thing for cutoff, of course, to remember is the Form 5500. I mean, I have it under plan termination because we do a final 5500. I mean, definitely to close out the filings, but you sort of do in a merger as well. When your plan is merged and the assets are gone, you're reporting a final reporting for a plan. So again, you want to make sure those cutoffs are working where one plan is ending and one's starting, and it's seamless, because the Department of Labor, as we know, asks for that information on Schedule H, so if there's a transfer, where is it going? And they will often match the amounts, and if they don't match, we've gotten questions or rejection notices of, wait, you said this goes to this plan, but this plan is reporting nothing close to that amount. So help us reconcile, okay? Inherited plan qualification issues are always exciting. So you got to know what you buy. And, plans, as I tell folks, sponsors, and attorneys is, it's not a car where you're just buying as is, or a house. Maybe it is at times, because corrections can be costly. And the key here is, bank accounts are closed. Companies are acquired. It's like, wow, we have now, let's say deposits we find out have been delinquent and being transmitted to the trust after pay dates. Well, who's going to fix that? Who's going to calculate earnings? Who's going to pay for that? Both companies look at each other and go, I don't know, I bought you, but I have all your accounts, and you have no money, I guess, technically. Well, wait, am I the sponsor? So who gets to fix this? So plan mergers, that's why they're a little stickier in that, when you're merging those assets, any, as the DOL says, any tainted monies, taints the plan the new, assets are going into. So you got to be careful. So you're kind of inheriting, if you will, plan qualifications issues, and that's why I have inherited. So you got to know, again, as you're working through the deal, if our clients decide to merge, we usually then start, especially if we're the buyer and we're representing the buyer, we jump in right away and go, okay, let's start doing some due diligence on the plan that you are inheriting, and the assets are coming as a plan-to-plan merger, because we want to kind of get to know what we're dealing with. So what do we look at? Department of Labor hot buttons are always a good start, right? Delinquent deposits in a defined contribution plan. Are the plan documents updated, or notices have gone to participants? Is there amendments out there that haven't been done that have to be timely? Record retention, if this has been audited before, if it hasn't, are we going to start kicking the tires and looking at how eligibility was administered? So do they have the appropriate records somewhere? I can't tell you, in my glamorous auditing career, I've been to storage complexes looking for forms and data to get comfortable with things that one of our clients as buyers are inheriting. So we've done quite a bit of due diligence, because again, you'll be amazed that something small can be costly for a small plan that's even never been audited, all the way up to a plan of thousands and thousands of lives. An eligibility issue of not letting people in on time, or missed contributions, or one of our recent favorites, eligible compensation, can be really costly. So we have, as representing the buyers, we go through and we have grids of what's eligible compensation for match and contributions, and have they been doing that correctly? Or are we going to inherit something that later the DOL will audit and go, you did this wrong, what's going on? So again, in a merger, there's a lot of war stories I can cover, but there's definitely things that you want to be aware of what are you inheriting, and you want to go in it with your eyes open, so that, again, if there's any way sponsors can negotiate who's going to pay for what, it will be much more effective and a happier marriage going forward. Now, switching gears to a plan termination, this is always my favorite, because we talk to clients and they say, yep, we've been acquired, or we acquired a company, the plan's gone away, we terminated, and they kind of use that term really loosely, and it's like, well, wait a minute. A termination means something very specific and distinct in reporting, okay, and in accounting. For you, sponsor, the plan has gone away. Great, congratulations. However, that may not, be a plan termination, if you will, and a reporting that requires plan termination accounting and liquidation basis of accounting. So I just want to mention that here, because we often have to always dig down, and I usually repeat it, even depending on the sophistication of my clients or the opposing team. I always go, I don't want to insult your intelligence, but I really want to know and make sure that we're actually talking about a plan termination, where this plan is ceasing to exist, folks are not accruing any benefits, they will either be paid out and can roll their monies out, you're paying everybody, things are going away, bye-bye. So nothing to transfer over from a sponsor standpoint or a group to group. So very specific. And again, as Amy mentioned, it is sacred in the deal process, because you have to decide a plan termination at some distinct moment. And if not, then again, you have fewer options afterwards. So, a lot of the companies we work with, especially, again, we're based in Silicon Valley, or we have an office in Silicon Valley that does a lot of benefit plan work. But just being in Silicon Valley and our San Francisco offices and things like that, we're seeing a lot of tech. And we work with a lot of tech industries, and again, have a lot of deals going on. So, it's kind of imperative for us there to understand, again, what the client's methodology is, if you will. And a lot of these tech companies have a process. Like a lot of them go, we're just going to, whatever we do, we're terminating every plan, because we don't want to inherit anything, and we want it gone, and we want the company we acquired, take care of it, do everything, we're good. And if the people become our employees, they can roll over, just like any other new employee. So we actually probably see that majority of the time in the environments we're in, because it's just a cleaner break, if you will. Now, if the final termination determination letter is requested, sometimes the IRS, puts a stop to when you can pay out people. So you want to make sure that you're aware of that. We were just recently working with a client, and they acquired a company, and they thought they were literally merging the plan. That's what the Human Resources group was told. That's what Finance was told. Then we found out, no, they've actually filed for a final termination letter, and that actually they do have the option to terminate. However, now nothing can happen with that plan, right? So, and my client has taken sponsorship, and they didn't even know it. They're like, great, well, it's past that time. We're the sponsors, and we have no chance, and now we got to wait sometimes for this letter to come back from the IRS before we can process distribution. So it's again good to remember to be aware of that is that being filed, and again, what are my options there? Final forms 5500 have to be filed. I touched on this a little bit. Again, anything going away down to the last penny requires that final filing and final reporting to the IRS and the DOL that says, hey, this plan has gone away. Again, reconciliation has to occur of amounts being paid out. The plan still has to file until they have money in the plan. So again, just because we've legally terminated a plan, you can report maybe some of the assets coming out if the new client, like in a merger, if the new sponsor is ready to take them. Otherwise, you can't just go, oh, well, we've approved a plan termination, so I'm filing the final 5500 and I have all these assets still to report on and all these participants. And then a lot of folks, of course, forget the audit piece, because if you still have over a certain number of participants in the plan, you'll continue to need an audit. So again, just because the plan has gone away or we've terminated, again, your filing and audit requirement doesn't just stop there. So you got to remember, and the filing due date for the 5500 is 7 months from when the assets go to zero. So again, remember that, because a lot of times clients, we are coming a little bit later, and if we're not brought into the process earlier or something happens, they kind of go, oh yeah, that plan, that plan termed, but I think we termed it during the year. And it's like, okay, well, when was the final 5500 filed? Because it was 7 months from when assets went to zero, not the plan's year end. That could be much later. Okay, so something to keep in mind there. And again, the final audits will go along as that plan has a certain number of eligible participants at the beginning of plan year. So oftentimes filings linger, and sometimes we can consolidate them, but sometimes they just pretty much linger into the next year. Liquidation basis of accounting, I mentioned, again, that's for finance folks. There are some new auditing standards on that, and accounting standards is that if liquidation is imminent, fair value accounting really kicks in. And of course, for benefit plans, there's a little impact depending on the investments in the plan. We, of course, have clients that have complex, hard to value investments in the plan, and this will come into play because we need to make sure they're reported at fair value because the plan is liquidating, and that's kind of going to be the actual exit price. But most often, because ERISA and the DOL requires, the assets are at fair value. And so, again, on the auditing and accounting side, we have a lot of new ASUs. We just got one issued actually in July about plans being, what is practical expedience evaluation methodologies. And so if they're at fair value, usually there's not a huge adjustment. But again, if you're kind of inheriting, like Amy mentioned, you'd be amazed at plans, sponsored by doctors or attorneys or smaller, maybe you wouldn't think of something as a smaller organization, but that the owners have kind of put in a lot of complex assets into the plan and has done well for that plan. But again, nonetheless, if something's happening, we got to make sure they're being valued and reported accurately. Defined benefit plans, again, I have them here. They're kind of a rare breed. There are getting less and less these days with the new mortality tables and how we're all, I guess, living a lot longer. These plans are becoming a lot costlier, and again, of course, most of them are underfunded, so they have other challenges. And again, when you're acquiring, or when, again, you're even merging up, or you're on either side, there's a lot of consideration to be given for defined benefit plans. Who's going to inherit the obligation? Is the plan underfunded? If it is, what are the options? Are they going to freeze the plan? Has the plan been frozen, and was that a soft freeze, meaning people continue to accrue but no new people go in? Or is it a hard freeze where everything stopped and no one's even accruing benefits or anything's happening? So, all that will determine the cost of actually administering this plan. We have a lot of our clients where they buy a company, they go, they have a defined benefit plan. I have no idea how much that's going to cost me a year. There's PBGC fees, it's an audit, there's actuaries, and then, by the way, it's underfunded. So, at the time that you're doing the deal, that's a good time to negotiate, okay, who's going to inherit the obligation? Are we going to do a buyout? Are we going to go buy an insurance annuity to pay this out? What are we going to do? So again, defined benefit plans by their nature have quite a bit of other nuances that folks have to be aware of when they're going through a transaction. I think I covered quite a bit, Amy. Do you want to take over?
We have a great comment from one of our viewers. Jan pointed out that something that can be important to consider for 401k plans is the timing of distributions for highly compensated employees. That you may want to wait until ADP and ACP testing have been finalized for that last year as far as if you're terminating the plan in case distributions are due. I've also seen them actually allow the distributions, but then have to reach out and contact them with adjusted 1099-Rs that show a portion of it wasn't eligible for rollover. And of course, if they did roll over their assets, then they have to pull some out of IRAs or other plans. Have you dealt with any of that directly?
Yeah, actually, that's a great comment, and that's a good place to note it in inherited plan qualification, because that's one of them that, from an audit standpoint, we have different requirements for compliance testing. But yeah, sponsors and inheriting plans, that's big. So that's a great comment of, are the tests done? Are they done timely? And then if there are refunds, yeah, where are they going to come out of, and who's actually going to process them? I think you covered a little, Amy, of course, who becomes part of a control group going forward. And how they test. But yeah, absolutely, when you're working with clients, that is on the list of have the tests been done and have they been done accurately, and what's look back periods, and again, back to record retention, is things going to be available for the classes of employees that you're inheriting. So yeah, great point.
Great. So we can move on to the buyer's plan, and we've touched on quite a bit of the moving pieces of the seller's plan, and of course some of the merger considerations. So ignoring plan mergers, if we just look at the buyer plan, whether or not the seller has a plan, we want to look at how bringing on new employees can impact the buyer's plan. And again, we're going to go back to our PAT buyer and JMS. So let's just say that in its first example, that in an asset sale, employees that PAT hires from the JMS company are actually considered new employees, as I mentioned before, of PAT buyer. Even if PAT bought that processing plant and everybody walks back in and does the same, into the same building, does the same work the day before and the day after that transaction, the asset sale goes through, but they're still considered new employees of PAT buyers. Of PAT buyer's company. So they actually have to meet the terms of eligibility for PAT's plan. Again, this is assuming that PAT has their own 401k plan. So they start over in terms of eligibility investing in PAT's plan, which does not impact their benefits over on the JMS plan side, but they do start over as new employees, new job in a sense when they come over to PAT's plan, which this may or may not go over well. Again, if it looks to them that they're doing the same job, there's been no impact in how they go about their day. And as part of those asset sales, we've certainly seen the buyer consider amending their plan to recognize service with the seller's company, whether it means for eligibility, crediting, or vesting in the buyer's plan. But this is not required. It's more something that, again, they've done as sort of goodwill towards their new employees. But again, it doesn't happen automatically, which is important to know, because again, people kind of look at it as, well, I bought most of that other company. These are the same people, but again, legally, it doesn't happen automatically. So if PAT wanted to give employees that they brought over from JMS a feeling of continued service in their plans, even though they're actually separate plans, PAT has to specifically amend their retirement plan to recognize service with JMS company. And if that's the goal, they have to be able to, as part of the conversation with the sale, PAT's going to want to make sure that John and Mary have details of PAT service for all employees that PAT intends to hire, at the time of the sale and into the future. And I say into the future also because people tend to forget that if they ever hire someone that's worked, let's say that they amend their plan and they say all service with JMS company is recognized in the PAT buyer company plan. If they hire someone that worked there 5 years before the purchase went through, they need to know that, and they need to know what their service history looks like too. So that can be a little bit dangerous in terms of making sure that they get all of the good data. So if there's a question of whether or not they can, but they know that they want to bring over employees that they hire as part of the sale, they can consider amending their plan to allow for immediate eligibility as of a specific date for employees that they hire as part of the asset transaction. So that essentially simplifies the administration both at the time of the asset sale and again in the future, because they can specifically write it to allow people in as of that date as part of the transaction or recognize service for people only part of that transaction. That way, if they ever hire somebody in the future and they aren't aware of the past service, they won't be kind of caught in the crossfire. So when a planned merger isn't part of the equation, the recognition of service in an asset sale is an optional feature and is generally only available via plan amendment on the buyer side. Now, when it comes to stock sale, the two companies that were previously unrelated are now considered under the same umbrella. And in our example, we're keeping it pretty simple and assuming that Pat is 100% owner of Pat Buyer Company and then buys 100% of the ownership or stock in JMS Company. So Pat now owns two related entities. So in the Pat Buyer Company retirement plan, employees of JMS Company that are now considered to have service back to their JMS hire date. It doesn't mean that they automatically come into Pat Buyer's plan, but it does mean that their service history is automatically recognized under controlled group rules. Again, they're not automatically brought onto the Pat Buyer Company plan as employees of the JMS Company. The two entities are still actually legally separate entities as long as Pat Buyer doesn't, shut down the JMS Company and bring the employees over. They're still running two separate entities, two separate tax IDs that are processing payroll and so forth. So those employees are still employees of JMS Company, now owned by Pat Buyer. The plan document that governs the Pat Buyer Company needs to be reviewed as part of this transaction. A lot of times I see documents that say that affiliated or related entities are not automatically considered participating employers, but they actually have to sign participation agreements to come on board. Again, many documents provide for the use of transition relief for the year of a significant transaction and the plan you're following, which allows Pat to take time post-purchase to determine whether employees of the JMS Company should be brought into Pat's plan by a participation agreement and when they want to do that. But it's important to take a look at that document before the transaction, because if they do want to bring people on immediately, as of that stock sale, the documents need to, say that. Whether if some documents again may say that all related entities are automatically participating, which Pat would want to know because they got to bring everybody on board immediately, or if the intent to bring them on is there but this plan document doesn't say it, they do need to amend that plan. Again, note that Pat, if this is assuming that the entities are two separate entities, so if Pat does want to shut down JMS and actually move all employees under Pat Buyer Company, like that's the actual entity processing paychecks, their past service with JMS Company is recognized from day one of those employees working with Pat Buyer. So since the entities are now related, so those employees may be eligible as of day one working for Pat Buyer. Again, it's important to get the service history from employees on all employees from John and Mary as part of that sale. Bertha, I'm not sure if you have any, I think you had a comment on eligibility being a DOL hot button.
Oh yeah, absolutely. And it's like multifaceted. It's actually a DOL hot button in the way of, it's different layers, if you will. Like when we think of, okay, well, eligibility, everyone's eligible upon hire. Well, there's entry dates, as you mentioned, past service. So again, in transactions, it's important to know, from a buyer standpoint, okay, does the company I'm inheriting or the plan I'm inheriting have correct eligibility requirements and past service histories, and who's, and eligibility also goes to age as well. I want to mention that because we kind of did a due diligence for a client, and just the records were a mess, and there was quite a bit of employees to go through to even, go, okay, is the census data actually accurate and good census data that we can rely on? Classes of employees, often in 403B worlds, especially when organizations are merging, and if they're, let's say, universities, we work with the universities a lot, there's a lot of classes of employees. Similar to, I guess it would be union versus non-union. So in the healthcare industry, right? So you need to know, what classes of employees are eligible now, or again, as Amy mentioned, is what's the document going to be amended to include? So we have a lot of war stories on eligibility, and again, it could be pretty costly. I always have to check with consultants on, okay, who corrects what and how much of employee deferrals has to be covered and match and earnings to fix things. And then, of course, our environment's just becoming so much more global, right? We work with a lot of clients who have employees abroad, who engage people that come from abroad. So, to understand also how is that going to work now, whether you're the buyer or the seller, sometimes that becomes a sticky point, and we're going to write a white paper on it soon, actually, at Moss Adams, because so many of our employees, actually not just, again, in our tech industry, but all over the firm, are dealing with, okay, we're opening up the boundaries and the borders, and what does that mean now for my eligibility as I go through a deal? So it's really important to do that. 403B world, again, I think we keep touching upon that because they're kind of a rare bird. And in this case, again, I just mentioned like universities, there's a lot of eligibility issues there because we're finding, just like eligible compensation, in that world it's pretty sticky because, again, it gets to be so complex. There's just so many different classes of employees, and when you bring them together, it's really tough. And, especially in acquiring, like let's say when a for-profit entity acquires a not-for-profit entity, that's another area where I just want to mention it, and if it resonates with anyone, please feel free to contact us. But we're seeing some of that, and we work through that, and that's eye-opening because I think the for-profit entities aren't realizing that if they're inheriting a plan that maybe didn't even come under ERISA, is what does that mean to them as sponsoring now a plan that's never come under ERISA? So, and never, has had to do certain things and now has to, and again, hasn't tracked eligibility, let's say, or, again, the custodial agreements have been with certain providers or haven't even been tracked properly. So there's a lot of kind of things to consider there, and we're seeing, like I said, most of them we're representing the buyers where they're buying kind of non-ERISA plans. So I don't know if others are seeing it go the other way, and that's been super tough to work through. So we're, trying to do the due diligence up front, if you will, so that we can kind of go through things like eligibility and eligible compensation, a lot of other things, and go, okay, how would this plan work if it was under this umbrella today? So that's some of the things I was thinking of. I don't know if that's hopefully useful for the audience, but.
I did have one other question from Jan come up on HCE determination and on the stock purchase. Yes, just, the compensation for determining benefits, only applies for participating employees, but certainly in looking at coverage, you would be looking at compensation with related entities. So, in a stock purchase, that becomes a related entity. So yes, you want to look at who the HCEs are based on their compensation in that related entity.
Yeah, and Amy, that's good to know because I guess, yeah, I should have clarified, and sorry if I'm doing that too late for the folks, but when I say eligible comp, I'm looking at the components, right, of compensation eligible for deferral and match calculation. That's a huge hot button for the DOL, and we're finding that it's becoming, again, super complex and hard to administer sometimes. Organizations go through, change in platforms, change in, employees and payroll administrators. So that's good clarifying is sometimes we mean both. Does that make sense? As we mean both, the components and, like you're saying, kind of how you define certain classes.
Yeah, absolutely.
Yeah.
We do have a question from Michelle. I don't know the answer off the top of my head. Wondering if you do. It says, what are the notification rules to the participants on transfer of sponsorship in an asset sale? Again, I'm assuming that means that the asset sale, that as part of the agreement, the buyer is taking over the plan. Is there any kind of notification needed to participants? In my mind, that comes in more from a planned merger, but any thoughts on that?
Well, I guess you mean if a buyer's taking over a plan and they're taking sponsorship, I would think a lot of communication. I mean, I'm not sure, I have to say which is required or not, but when we've worked through it, we've just seen a lot of communication come from the existing plans providers, if you will, that says these are the changes, this is plan design, or this is the new custodian, or this is kind of what's happening, and this is when there's a block out, this is where you can transfer money, this is what happens to your loan if you don't transfer. So I don't know if there's a timing requirement, but there's a lot of disclosure requirements. So, and most consultants would know. I mean, like I said, I just know I've seen it all come through pretty timely and quickly when you're going through deals, but I'm not sure which part of it is, required. But there is quite a bit. Yeah. Yeah.
My thought was just, if it's simply just from the simple question of notifying people with change of plan sponsor. I mean, that would, in my mind, be an amendment to the plan, which means that participants have to get a summary of material modifications, yes. But that's well into the next plan year that actually has to kind of go out to them. So,
correct.
So that's the only notification I can think of if it doesn't involve things like a blackout or custodian change.
Yeah, and I agree. That's pretty straightforward.
Okay. So I'll jump to questions in a minute. I just want to go to the last slide that we have here is a summary for you. You know, obviously we don't have time to cover all possible aspects, but we do have a brief summary that we wanted to give you of things to consider in both an asset or stock transaction, and, you know, depending on if it's the seller, buyer, or both that have retirement plans. And of course, the key takeaway in our minds is that, you know, everyone should be aware of, one, the plans that exist, and two, what the goals are for both the buyer and the seller before the transaction goes through. And to make sure that you bring in the appropriate parties, whether it's attorneys, accountants, compliance service providers, or others, sooner rather than later. Again, the worst call we get is the acquisition happened and now our options are limited. People, you know, we don't want people upset about realizing what they can't do now that the actual purchase has gone through. So we are going to put up a fourth and final poll question, and that's how confident you would be that a record keeper or custodian that you work with would be helpful in terms of if you were heading into a planned merger or termination. Let me go ahead and launch that.
And while you're answering that, again, Amy and my, I think, information is available. If not, please contact us if any questions come up, and we can most certainly point you to the right direction if we don't know the answer.
Okay, let me just see if I have any other questions that we can address now. Let's see, merger with a planned termination happens in late 2015. Is HCE comp for 2015 or 2014 used in discrimination testing? Merger with planned termination. So the planned termination, I mean, for 2015 testing, the HC comp is going to be based on 2014. If you're terminating the plan, you know, with the last contributions in 2015, that's the last discrimination testing needed. So the HCE comp is for 2014. If it means that you're going into the 2016 year, then of course you use the 2015 compensation. I don't know if I'm answering what you're asking.
Yeah, it goes with the year it relates to, right?
Right, right.
Yeah.
So it just depends on what the timing is on that. The termination of the plan, when the final contributions are made. If it's a partial plan year, you know, you still have to do testing for that partial year. And of course, yeah, the compensation does depend on what year we're looking at. All right, so I'm going to go ahead and close that poll. We've got 60% of people are very confident that they would get assistance, which is great.
Oh, that's great. That's always helpful.
And we will, yeah, I was going to say, yeah, I don't think I see any questions here that we haven't addressed. I did have an earlier comment from Jan again that I think I addressed, actually a couple here that I think I addressed as I was speaking. So, and a good comment, and again, the summary of material modifications in an amendment situation. But I think we've got everything. So again, as Bertha pointed out, if anybody has any questions, please feel free to reach out to us. Our email addresses are here. And thank you so much for attending today.
Thank you.